Hi, everybody. This is Tim Melvin coming to you from down here in Central Florida on yet another nice, hot, muggy weekend. We love that weather down here. Went down to Disney Springs last night to see the new Spider-Man movie. Checked out the new Planet Hollywood restaurant. Gonna give that a solid C. Just didn't excite me. I probably won't be going back. But we did stop for drinks at Art Smith's Homecoming, which is a farm-to-table Florida-based restaurant that is best known for, and we had no idea about this place till earlier in the week. Someone told us about it, so we did stop in for a drink to check it out. We're going to be going back for my wife's birthday dinner this week. The restaurant specializes in moonshine and fried chicken. I just don't know how I can't be a regular at this particular establishment. So we'll be checking that out later this week. It was a great night down at Disney Springs if you're down here in the Orlando area. Fantastic place. We almost never make reservations. We go down a little bit early and we just kind of cruise around and see where we can grab a table or space at the bar. They have some fabulous restaurants, so we just kind of cruise around and check them out. If you're ever down here, it's a great way to spend an evening. So anyway, this week Ray Dalio was out, Bridgewater Associates, of course, for the world's largest hedge fund, and he had some remarks on kind of where we are in the economy and the Fed cycle. And he said, we're closer to the end than we are to the beginning, but he said that the music's still playing, so our job here is to keep dancing, but keep an eye on the exit and continually read the tea leaves. Now, that statement actually made me really nervous. Those of you that were around back in the middle of 2007, there were similar comments made by a gentleman named Chuck Prince, who was then the head of Citigroup. And he said, our job is to keep dancing as long as the music is playing. He was referring to the fact that there was still plenty of liquidity in the markets. Things were going very well. Subprime was just a blip on the radar at that point in time. So as long as the music was playing, Chuck Prince and Citigroup were going to keep dancing. Of course, they danced themselves right into one of the biggest financial catastrophes of all times. Let's hope that Mr. Dalio is not leading us down the exact same path. Now, we do have the fourth rate hike since the cycle changed back in December 2015. Made me mindful of something. It was Marty Zweig's three-step and a stumble rule that he first revealed back in his book, Winning on Wall Street, which came out, I believe, right around 1990. And his theory was if the Fed raises rates 3 times in a row or more, the markets are bound to stumble. We're at number 4, so I would say the rule is invoked. Now, something else interesting about the Marty Zweig book. That was the hottest financial book of its day. Mr. Zweig was coming off a remarkable run in the 1980s. He was one of the best growth stock investors on the planet at the time. And those of you, again, you have to be old like me, but the Friday night before the crash of 1987, Mr. Zweig went on Wall Street Week with Louis Rukeyser and called it. He said we were going to have a crash on Monday. Brilliant guy, fantastic track record, pretty good writer too, and the books are still sort of relevant. So if you run across a copy, you might want to read it. But I remember talking about this in the Dean Witter office where I worked, and I was talking, I said, we've got the three-step and a stumble thing going on here with what the Fed's doing. And everybody looked at me like I had points coming out of my head. They'd never heard of it. And I remember being surprised because this was the IT finance book of the day by the IT fund manager of the day. And none of the brokers in the office had taken the time to read it. Everybody in the world of finance and investing was talking about it, but the brokers were not. And that's when I started to get my first clue that probably most of the brokers were better trained in selling than actually evaluating investing in the frameworks. They spent a lot more time on marketing than they did on educating themselves about investing. Not knocking brokers, just keep that in mind. I have a long list that I give people of books. And if you're going to deal with a financial advisor, you should go down that list and ask them which ones they have read. If they're not at 50%, you probably don't want to deal with them. So anyway, fourth rate hike. Jamie Dimon of J.P. Morgan was in Paris this past week, early in the week, and he said when asked about where we were in the Fed and policy cycle, he said, you know what? We're ending the easing, but nobody knows what's going to happen here. Everybody's got a prediction. They're acting like they can deliver, very positive predictions about how the unwinding of quantitative easing is going to go. But he told his audience, we act like we know exactly what's going to happen, but we don't. We've never done this before. We've never had this level of quantitative easing in the system, much less unwound all the QE that's been going on. So as the Fed begins to sell bonds later in the year, we get another rate hike. I don't know about December. I don't think the economic growth is there, but certainly they're going to do another one at least sometime early next year. We don't know how this is going to play out in the markets. It could all just be smooth sailing, no problems. Could be catastrophe. I don't know. You don't know. Jamie Dimon, who sits on top of one of the biggest piles of money in the world, is at least smart enough to admit he doesn't know. Now, Mr. Dimon, by the way, this guy, he's easily becoming my favorite banker next to John Allison and Home Bank Shares. He was on the JP Morgan earnings call on Friday morning, and he absolutely went off on the United States government. Now, I'm just going to peek away here because I want to make sure I get my notes right. He lashed out at the government. He said the government is hurting, not helping on major items like education, infrastructure, income taxes, growth policies. He pointed out that, U.S. business is pretty strong. We've been able to grow 1.5% in face of all this government regulation. But if government would get out of the way, we would grow at a much faster rate. We would create a lot more jobs. The gridlock in Washington is actually hurting the American economy and the American citizens. He really, he used all kinds of cute words, and he just, he's not real happy with the U.S. government. Says we no longer get it when it comes to things like business policies, taxes. We've turned into one of the most bureaucratic, litigious, and confusing societies on the planet. And he pointed to some of the other countries he's been in recent weeks that get it, that being pro-business, lowering taxes, creates jobs, and benefits all the citizens. Our government clearly has not gotten that, I'm going to go ahead and say, for decades, and has been much more of a hindrance than a help, not only to business, but business creates jobs, which creates extra tax revenue, which improves the education system and the infrastructure system, provided the goofballs in Washington don't spend it incorrectly, but that's a whole nother subject. He really took the U.S. government to task. That kind of follows up on some of the things he said in his J.P. Morgan shareholder letter that came out earlier this year. And if you've not read that, you really should. It ties into an article that I read. It's one of the best articles I've read on the subject of government regulation and the economy in a long time. Came out by a fellow named Matt Ridley. He's a British journalist, and he wrote on Capex.com, that's CAPX.com, an article called The Case for Free Market Anti-Capitalism. And he said something that I've been saying for some time, that what's passing off for capitalism in the United States right now is not free market capitalism, it's crony capitalism. He points out that that a lot of what passes for big corporations these days are subsidy dependent and more in partnership with the government, and that's not true free market capitalism, that free markets operate almost exactly opposite the way that big business does. And there's one other really interesting point in the article. They went and they looked at peaceful countries and not so peaceful countries, and what they found is that the former government, it didn't matter. Democracy didn't play into this at all. What mattered was efficient free markets that worked. No matter what kind of government we had, if we had that type of economic system, it was a pretty peaceful, prosperous country. You can't engage in trade if you're constantly at war. That's just a simple fact. Anyway, it's a fascinating article on the web, free content. Don't agree with everything Mr. Ridley had to say in the article, but it's certainly thought-provoking and worth your time to read as we head into the new business week. Okay, looking around all this, are you confused? So is everybody else, and anybody that's not confused doesn't understand the situation, as Charlie Munger pointed out last year. Macro fund managers, the big guys I'm talking about, Soros, Paul Tudor Jones, Brevin Howard, Moore Capital, all struggling as correlations have risen. Everything's kind of acting in concert, and volatility has dropped. These people are finding it almost impossible to make money, and they seem to have missed the biggest trend of all, which I don't know how, if you're a macro manager, you've missed the slow, steady, consistent rise in stock prices for the last 8 years. But these guys have. I guess they're busy tracking money flows between countries and currencies. I really don't know what they're watching, because it looks to me, I'm not a macro guy, that the deflationary cycle in commodities and the upward move in stocks should have been huge macro trends that enabled everybody to make tons of money. They didn't. They have not. Most of the funds that I mentioned are really struggling to find ideas, and most of them are losing money for the year. Paul Tudor Jones' shop, I read, in Moore Capital, they're laying people off. They don't have have enough assets under management to continue to justify the employment. More Capital is having one of the worst years it's had in a long, long time, and that's Louis Bacon. He's a very bright, smart guy who's consistently made money. We aren't the only ones that are confused. Some of the smartest guys on the planet that have been successfully trading macro trends for decades are struggling just as much as everybody else. Now, Dick Beauvais, the bank analyst, much quoted bank analyst, and I wish I could change opinions as often as this guy does, but he came out and he said there's going to be a merger boom. If you look at the stress tests that were released last week, banks have tons of excess capital, but the economy's not growing fast enough for them to deploy it anywhere. So what are they doing? They're buying back stocks, they're raising dividends. That's all great, but eventually if you want your stock price higher, you have to show some growth, and there's only one way to get growth. Guess what that is? Acquiring another bank. And there's a trickle down. You're going to get larger banks. They're going to acquire the mid-sized regionals. The mid-sized regionals will acquire the small regionals. The smaller regionals, of course, are going to be buying the community banks. Community banks sitting at the bottom. Net interest rate margins are not going to go up much anytime soon. We may see, another 25 basis points. But even when pushed, even Janet Yellen admitted, it's going to be really tough for the economy to show sustained 3% growth anytime over the next couple years. If we don't have improved growth, we're not going to have higher long-term interest rates. It's a really simple equation. Net interest margins are going to continue to struggle. Washington has missed the easy layup of bank regulatory reform. Should have been done by now, or at least introduced further along in the discussion. They have not. They've kind of punted that ball, and they've really blown that call. So now regulatory reform, I think everybody expected it way too soon, but I thought we'd at least be a lot closer to it by now, with a goal of late 2017, early 2018 for some type of meaningful reform to pass. Now I think maybe we're well into 2018 before we see something like that, and Lord knows where we are on tax reform. So the only way for these banks to grow, rates aren't going to give you any relief in net interest margin. You're not going to get tailwinds from a growing economy. If you want to show earnings and revenue growth, you have to buy another bank. We own lots of banks. Most of our bankers are willing to entertain either buying another bank to grow themselves, and many of them are actively considering the opportunity to sell the bank at a premium to the current stock price. Either outcome is okay with us, because either way, the stock price should go higher. That's good for us. Anton Schultz of Menden Capital, one of the better bank stock investors out there, has a tremendous track record. We end up owning a lot of the same stocks as him. He favors the regionals and communities, but he also likes the big banks. He said, looking at the big banks, earnings were fine. People sold the earnings because they didn't hit this number or that margin percentage. He said overall they were fine, and that over time he thinks the continual return of capital in the form of dividends, buybacks, and possible M&A activity is going to continue to be a driver of bank stock performance, and he would be a buyer of any pullbacks in the bank stocks. We would love to see a pullback in our bank stocks. It would make us so happy. We sent out a very short buy list for the Banking on Profits portfolio this week. We wished it had been a lot longer. And that's kind of where we're at. We're on the fence. If it keeps going up, we've got some stuff that's close to being ready to sell. And if it keeps going down, well, we've got a few names that we wouldn't mind picking up, especially on the real small bonus pick side of the equation. Let's see, this week, really nothing big on the book front, nothing new that really stood out and bowled me over. Just some recreational reading that was sort of middle of the road. Nothing I'm going to talk about because it's not worth recommending. Did finish up with Eli Broad's The Art of Being Unreasonable. If you've never read that book, go ahead and give it a read. It is an excellent overview by one of the better investors and businessmen of the last 50 years. Fantastic read. Now, baseball's back. The All-Star game is over. We're going to get back to baseball, and we're starting kind of how we finished here. The Orioles have dropped 2 in a row to the Chicago Cubs in interleague play. Gave up a lot of runs, scored a lot of runs, and gave up a lot of runs in both games. So the offense getting the job done. Pitching, not so much. Could be a very long second half of the year if we don't find some pitching help as the trade deadline approaches. We'll see how it plays out. I'm hopeful, but expect to actually be disappointed on this one. The pitching's just been horrible for the Baltimore Orioles. Bryce Harper's still hot. He knocked out 2 home runs here the other night. Let's see. Harper's hot. Oh, Cody Bellinger hit for the cycle. The Dodgers keep getting it done. They've won several in a row now, and I think they're ready to run away with that division. don't think anybody there can keep up with them. The Rockies and the Diamondbacks have made a good run, but the Dodgers look ready to go. The Houston Astros are staying hot, and the Milwaukee Brewers. We talked about this in our baseball preview, that Milwaukee had gotten a lot better, much better than anybody expected. But I didn't expect them to be this good. They are really on a roll. So anyway, the Orioles this week, Rangers after we got one more with the Cubs today. Going to start here in a few minutes. Then we've got the Rangers and the Astros. So it could be a really tough week for Orioles fans. Fortunately, World Market had a huge wine sale this week, 30% off if you bought 12 bottles or more. So the wine fridge is stocked. We should be able to get through a week of really bad baseball and horrible pitching by the Baltimore Orioles. Hopefully I'll be surprised, but I'll be surprised if I'm surprised. Okay, we got two huge events around the Melvin House today. First off, if you missed it, after Wimbledon this morning, BBC announced the identity of the 13th Doctor in the Doctor Who series. I think it's 13th. I hope I'm right about that. But anyway, they revealed that Jodie Whittaker, a British actress, will be the new Doctor Who, the first time in 84 years that the Doctor, the time-traveling Time Lord, will be a female. The internet has blown up over this, mostly pro, but, just can't make some folks happy. They don't think the Doctor, the time-traveling Time Lord, should be a female. I think it's great. Obviously, my two Whovians, my wife and the young daughter, are over the moon about it. Can't wait to see the Christmas special. I'm sure we'll have a countdown calendar on the wall to the Doctor Who Christmas special before too terribly much longer. Then, of course, the big news tonight. Game of Thrones is back. We are Game of Thrones junkies in this house. We talked about that not long ago with the Iron Bank episode, where the Stannis Baratheon goes in and he's trying to get the money from the Iron Bank, and the Iron Bank says, we don't like stories, we like numbers, and your numbers are not good. So Stannis' associate gets up, gives a very impassioned speech, Stavros, and the Iron Bank decides to buy the story and ignore the numbers. You want to guess how that ended? Stannis is defeated, he's killed, the Iron Bank does not get paid back. Much like the Iron Bank, I prefer numbers, not stories, and I've learned not to override that one simple rule. But anyway, Game of Thrones is back, and speaking of numbers, Vegas is making book on who lives, who dies, and who sits on the Iron Throne by the end of the current season. If you care, Daenerys and her dragons, they're way far the favorites at 7-2 to take possession of the Iron Throne by the end of the series. And that's followed by Jon Snow at 5-1. Virtually everybody has some kind of odds on them to die. That's sort of how the series works. You just never know who's going to get it next. But anyway, season premiere, Game of Thrones tonight. We will be watching it as the entire family is hooked on that excellent HBO series. Anyway, big week coming up. We've got lots of small bank earnings. The Banking on Profit update is going to be enormous on Friday as we catch you up on what's been going on with the stocks in the portfolio and their earnings reports. Healthcare is supposed to come to a vote on the Senate later this week. Hoping that gets voted down, because what I've seen of it, it's not a great fix. We really should have repealed the old legislation, rolled everything back, and started fresh. Instead, we're going to try this Band-Aid approach. We'll see how it works. Whatever happens, I don't think the market's going to like it very much. There's a lot of uncertainty around this package, and the stock market right now hates any form of uncertainty. We do have some U.S.-China economic talks going on this week. They could drive a headline or two, but looking like a lot of folks have headed out for the Hamptons, and it could be a quiet week with just a couple news-related blips. So anyway, that's what we've got. We've got the new Community Bank Stock Investor has gone in to be converted from Word to a PDF. The tech folks do that for me because left to my own devices, it wouldn't turn out right. But anyway, that should be out very early in the week. We've got two new focus picks in there, two small banks that I think you can add to your portfolio right around current prices. They have very low risk, substantial upside situations. So that's kind of the week that was, the week that might be, and we're just going to sit back, watch a little bit of baseball, listen to the women talk about Doctor Who, and get ready for maybe some hamburgers on the grill and Game of Thrones tonight. So anyway, I'll check in with you guys next week. Have a great week, everybody, and talk to you next week. Bye.